OXLC, this 20% yield is proof that income investing works. This article was written by Rita Morwa. Summary: investors make frequent mistakes, especially when it comes to buying income for retirement. Selling shares for income is not the same as getting paid monthly. I use funds to provide added income to my portfolio through the diligent application of managerial skills and knowledge. I am Rita Morwa. I have been advising individual and institutional clients on high-yield investment strategies since 1991. I lead the investing group High Dividend Opportunities, co-authored by Treading Softly. To be human is to be prone to mistakes and errors. Usually it's caused by our natural inclination to be biased. For investors, recency bias is a massive peril. The less experienced investors will hear about an opportunity and immediately pull up a chart. If it is not climbing left to right, it's written off, and no further understanding or research is performed. The issue here is that many investments provide returns other than simple price movement when it comes to the market. To blindly rely on charts is a complete failure to understand how the market works and an abdication of one's responsibility to dig deeper. Closed-end funds, or CEFs, are governed by regulations and are required to pay out 90% of their taxable income and the vast majority of their capital gains as distributions to their shareholders. This means that they have limited means to grow the fund without share issuance, and any errors by management can be highly difficult to recover from. The best funds see a sideways trending net asset value, or NAV, over the long run, with an outsized portion of their returns coming from distributions to shareholders. So that chart champion would miss out on wonderful income opportunities because of the gap in their understanding. Today, I want to look at a controversial fund that helps illustrate this wonderfully. Let's dive in. How you keep getting it wrong. Oxford Lane Capital, OXLC, yielding 19.8%, is a CEF that invests in the United States economy via debt. To do this, it buys equity tranches of CLOs, collateralized loan obligations. We covered OXLC in late September and are providing an updated thesis based on the CEF's third quarter earnings and reiterate our bullish outlook for this income-focused sector. OXLC reported an extremely busy quarter. The headline numbers appear fairly uneventful. Source GAAP NII, net investment income, was down 22 cents, even with where it has been the past 2 quarters. Core net investment income, which includes an adjustment for the cash flow from CLO equity positions, was at 32 cents. It was down from last quarter, but still comfortably covering the $27 in quarterly dividends. NAV was down 3% from last quarter and about 1% from a year ago. For an investment that distributed 99 cents in cash, a $5 reduction in NAV is not significant. Additionally, OXLC announced dividends will remain at 99 cents per month through March 2025. The real action happened below the headlines. OXLC backed up the truck, buying CLO equity. Sales repayments were very high at $160.2 million. That is more than the prior 4 quarters combined. OXLC reinvested all of those, plus $252 million from the issuance of new common shares, plus $46.8 million from preferred share issuance, and about $80 million in retained cash flow to invest $540 million for the quarter. Yes, OXLC is paying a 20% yield and still has extra cash to reinvest. In gross numbers, this is the largest amount of new investment that OXLC has completed in a quarter. As a percentage of the portfolio, 2021 was a similarly aggressive growth year. OXLC had net investment activity of $644 million in fiscal year 2022. OXLC's fiscal 2022 was April 2021 to March 2022. It was this growth activity that led us to predict dividend raises and designate OXLC as our pick of the year. For 2022, a pick that has met with an awful lot of scorn as the prices of pretty much everything debt declined dramatically in 2022 and 2023. Debt prices went from all-time highs in January 2022 to all-time lows in October 2023. OXLC's price fell a lot. Here is OXLC's price compared to the prices of ETFs that trade incorporated debt and U.S. Treasuries. This price decline brought out the total return crowd in force. I can't tell you how many jokes have been made at my expense for choosing OXLC as a pick, off the year and then having such a large price swing. But total return, wow! Except they aren't. OXLC has handily covered its distribution with cash flow every year since that article. In fact, OXLC has increased its distribution from 0.675 month in December 2021 to zero point 0.9 month today. That is a 33.3% increase in just 3 years. From a price standpoint, January 2022 wasn't the best time to buy OXLC. Of course, it wasn't the best time to buy almost any stock, and it was a bad time to buy anything debt-related, as the Fed embarked on a much more aggressive rate hiking cycle than anyone predicted, and debt markets experienced a lot of turmoil. From an income standpoint, shareholders received every dollar they expected to receive, and distribution increases resulted in a good bit more than expected. Looking forward, investors can expect more distribution increases, as we see a setup very similar to what we saw in December 2021 in terms of cash flow. OXLC has $475.1 million invested in CLO equity that has not yet made its initial distribution. This represents the embedded growth from OXLC's recent investments. We see the higher share count quickly, but we won't see the cash flow benefit for a few quarters. Additionally, OXLC has extended the average reinvestment period on its portfolio from November 2026 to September 2027, a very significant move. The reinvestment period is favorable for CLO equity holders because it is the period where the manager of the CLO is allowed to reinvest any principal payments received from loans. With the average loan trading at $96.40 dates for every $100 in principal, when those loans repay prepay, they are paying $100 par. During the reinvestment period, the manager can reinvest that $100, buying more loans that are trading at an average of $96.48. This has the effect of increasing the par value owned by the CLO. Since the debt tranches are entitled to receive a fixed amount of par value, the excess generated is directly to the benefit of the CLO equity investors. Much has been made about a dividend yield near 20% being unsustainable. It should be. The price of CLO equity should be much higher, and therefore the yield should be lower. Yet, for whatever reason, CLO equity funds have been left relatively unhindered to buy up CLO equity at low prices and very high cash yields. CLO equity is enjoying above-average cash flows right now as default rates remain much lower than all the experts have predicted. Cash flow from CLO equity will remain higher than normal until defaults materially rise. That is probably going to happen eventually. Is OXLC going to continue for 20 years without ever cutting its dividend? Probably not. Someday, defaults will rise, and OXLC's taxable income is going to decline from what it was the prior year. As a CEF, OXLC is required to distribute substantially all of its taxable income. So, when OXLC's taxable income declines from the prior year, it has a choice of over-distributing and eating into NFV or reducing the dividend. Of course, OXLC's distribution might go up to 12s per month, then get cut back to 9s. It all depends on when the cash flow gets disrupted and how much of a capital base OXLC has built before it does. There will be variability in OXLC's distribution and the distributions of all CEFs over long periods. It is inherent in the CEF structure. With CEFs, you should expect that the distributions will vary over long periods, and that the distributions will make up substantially all of your total return. This is an investment vehicle that is designed and legally obligated to provide cash flow. If you don't like or want that, don't invest in CEFs. If you want prices to go up forever, don't buy CEFs. If you get distressed because NAV tends to decline over long periods, don't buy CEFs. If you want boatloads of cash flow, and to convert the total returns from a sector into cash in your account every quarter, CEFs are for you. A lot of the complaints and bearish views on OXLC that I come across stem from a fundamental misunderstanding about what closed-end funds are and how they work. You can read more about the CEF structure here. Is OXLC going to pay 9 month forever? No, there's nearly 0% chance that happens. CLO equity returns are significant over the long run, but they are quite volatile over shorter timeframes. The distributions that OXLC pays will represent their current taxable income, which will be higher during some periods than during others. Right now, it is relatively high. In the foreseeable future, we expect that it will go even higher, barring a disruptive event. So for right now, OXLC is paying out 0.9 cents. In the near future, we expect it will pay out more. Over the next 10 plus years, OXLC will have years where it pays out more and years where it might pay less. Eventually, default rates are going to trend up and go back above long-term averages. It is fantasy land to believe that the near 0% default rates we've seen for 3 years are going to continue forever, that nobody is ever going to default on a loan again, and that unicorns will dance on rainbows raining money. That's why CLO equity produces so much cash flow, because it is paying now to justify the risk that at an unknown point in the future it will absorb credit losses, and the cash flow before the defaults has to be enough to offset the losses when defaults happen. Historically, CLO equity has paid more than enough to justify the risk, with the equity portion of CLOs having the highest total returns of any other CLO tranche and materially higher than investing in corporate loans directly. We believe that defaults will continue to be much lower than historical averages this cycle. That's why we've been so bullish on CLO equity for several years. So far, we have been right, and defaults have been minimal, even as prices have declined, allowing for investing at higher yields. We are getting paid as if defaults are high, and they aren't. For that, we can simply say, thank you, market. Some investors are so fearful that they won't be paid 20% forever that they choose to invest in places where they will never get 20%. Conclusion: with any CEF, I don't recommend investing in it until it has 18 to 24 months under its belt. This is because its NAV often sees the highest level of volatility and instability during the initial years. OXLC has provided a 52% total return since its beginning, which is nothing to scoff at. But if you had waited 24 months to invest, its total return jumps to over 100%. Looking forward, I will continue to collect outsized income from OXLC, recognizing that it won't pay this level of income to me forever. Part of the beautiful nature of my unique income method is that it combines CEFs, ETFs, fixed income, and common equity into one homogeneous whole. With no less than 42 unique investments, our rule of 42, you can have some growing dividends and some variable distributions, all while seeing a steady increase in your overall income. High Dividend Opportunities has seen 27 dividend hikes in 2024 this year and 7 dividend cuts, creating organic income growth without including any reinvestment of excess income. Is your portfolio growing in income and value? If so, I'm so happy for you. If not, perhaps it's time to embrace income investing. That's the beauty of my income method. That's the beauty of income investing. This article was written by Rita Morwa